Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcast.
So what we also do is we also try to, again, put the laws of probability more effectively in our favor by selecting or by using confirming indicators. And we talked about earlier on just about trying to establish a mechanism for putting the laws of probabilities in our favor. And so one of the analogies that I use is looking at your price charts as if it's a crime scene, and recognizing, of course, that a crime scene investigator cannot convict on one clue alone. Well, we can't just go in and essentially create a directional bias on a particular pair value without first trying to establish some more clues to support our thesis. Well, that's where your confirming indicators come into play. And for confirming indicators, again, we're just simply trying to bring another tool into the equation to help put the level of probabilities on our side, because that is really what success in trading these markets depends on. We use the chart patterns and indicators to help us make educated decisions, but of course recognize that there is always the possibility that we're wrong. If we can do everything possible to put the laws of probability in our favor, then we have a better chance of actually making an educated decision, and of course taking advantage, ideally, of a profitable trade. Now, there was just a quick question with respect to the charts that I was using. Those are actually daily charts. So those are our end-of-day charts, essentially based on pair value daily openings and closings. And the one thing that I like about these FX options is that you may very well be a spot market FX trader. So you might go in and trade your 5-minute charts and so on and so forth, and look to generate a paycheck trading those markets on an intraday basis. But the fact is, what's great about these FX options is that you can also have a bigger picture view of the pair value, put that in place, and let that work on a bigger time frame, and on a day-to-day basis just move in and out of that currency pair, looking to make short-term trading profits based on your short-term observations. So when we're using these options, we're using our daily price charts to establish an intermediate-term outlook on the particular pair value. Now, what we want to do here, just to again help put the laws of probability more effectively in our favor, is we want to add those confirming indicators, and we look for confirmation of direction by applying these lower indicators to our charts. If everything agrees, then we have a higher probability of being correct in our directional bias. One quote that I like to use, and this pops up in a lot of our different seminars, because I think it holds true, and it's a quote by John Bollinger, and many of you guys are familiar with Bollinger as being one of the pioneers, essentially, for technical analysis, indicators, and an oscillator development. But he essentially suggests that I'll paraphrase, one of the most important rules for successful trading on a technical basis is not using too many indicators. In other words, find a couple of indicators that work effectively for you. Don't try to use any and every indicator available, because really there are only 3 pieces of information that any one indicator can digest, and that's, of course, time, volume, and price action. And so although there might be hundreds of different indicators available to you, recognize that unless you're using different time frames, many of them are going to tell you the same thing. We want to keep things as simple as possible, and by avoiding, by keeping it simple from a trend and support and resistance perspective, and by keeping it simple from a technical indicator selection perspective, we can make it a lot less painful in terms of establishing and managing positions in the market. Now, there are three groups, as I mentioned, and just to kind of get a little more focused on these groups, the first type of indicator that we would look to use would be a momentum indicator, and you can see here that I have RSI, stochastics, commodity channel index, there's Williams percent retraceable, but recognize if you're using one of these, you don't need to have any of these other ones on your chart. Now, I use the relative strength index, and we're going to talk a little bit about that today as well. So from a momentum indicator perspective, I use my relative strength index. From a trend identification perspective, we can use moving averages. We can use average true range that essentially tells us really the price range and whether or not the range is trending higher or lower. I use MACD. So your MACD is going to help us, or our MACD is going to help us establish when a trend is coming to an end, when a new trend is getting underway, and it's going to give us a little bit of an earlier insight over and above what your moving averages can do. Now, one of the questions come up just, is it wise or strategic to look at longer-term charts, say weekly or monthly or yearly, in doing daily trades? Well, I always believe that you want to trade in the direction of the bigger picture trend. So, clearly, if the bigger picture is saying to the downside, then any bigger picture trend or any sort of shorter time frame trade that you take, you will have a higher probability of seeing a continuation in that direction. But we can look for reversals in that bigger picture trend on our daily charts and trade our directional views based on that, going against that longer-term trend, as long as we have our exits in place and as long as we have our targets in place to lock in our profits. So it is better to trade against or trade with the bigger picture trend. There's no question about it. But as long as you are your risk-reward proposition is worthwhile, then if the trade sets up on a daily chart, I believe that it is there's nothing wrong with taking a trend that is going against the big picture. Remember, the market, the big picture trend has to reverse at some point. And so what we're doing is we're taking advantage of a short-term trading opportunity with the possibility that the bigger picture trend is going to reverse, but we're going to manage it based on locking in our profits on that shorter time frame. Now, the other indicator that we could use conceivably is volume, and I just use the plain old sort of simply the volume if there are in fact underlying shares trading on a particular security. This really doesn't have that much of an influence on what we're looking at in terms of these pair values, because recognize in the actual spot currency market, you've got millions of dollars, trillions of dollars trading hands. Volume is not really a factor. What we really want to pay closer attention to is momentum, in particular price moves, and of course what particular trend is underway according to our MACD. So let's look at our MACD as an indicator first off. MACD stands for moving average, convergence, and divergence. It's kind of a hybrid of your moving averages that you would see applied to your price charts. Essentially, we can use this to identify overbought and oversold conditions, which I'll talk about in a moment. And we can also use it as a way of identifying convergence and divergence between our oscillator and the price. So in other words, if we see the MACD moving to the downside while price action or pair value action continues to move up, we can look at that as a conflicting indicator, suggesting that the price action is going to change or reverse because the trend is beginning to lose strength in that direction. So it's a warning of an early warning of a possible trend reversal.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.